Chapter 3: Risks in Investing in Stocks. Understanding risk and volatility are two of the most important things to keep in mind with the stock market. There are many different types of risk in the stock market. Some are direct, such as a small company that has the potential to make gains because of innovative products. Others are indirect and external. You can't manage all types of risks. Some come out of the blue, like the 9/11 terrorist attacks or the 2008 financial crash. So, if you think that you can control every form of risk, take a deep breath and realize you can't. In this chapter, we are going to try and describe every major category of risk investors face, and if possible, we'll suggest ways to deal with them. Emotional and person risk. First and foremost, you can control the risks to your investments that come from personal factors. These include fear, impatience, and greed. Emotions like these can be hard to control, but learning to take charge of them is essential if you are going to be a successful investor. When real money is on the line, these emotions can become strong and overpowering. You must not let that happen. The most common problem when it comes to emotions and personal risk is fear. When a stock market starts looking bearish, many investors immediately jump ship. They are making a huge mistake. A good investor is not getting in and out of the market at the slightest sign of a problem. In fact, selling off when everyone else is could be one of the biggest mistakes individual investors make. By the way, that doesn't exempt large investors. Many professional traders are subject to the same emotions and exhibit the same behavior during downturns. Massive sell-offs are what cause bear markets to develop. First of all, remember that you are looking to hold your investments over the long term. So, the ups and downs of the market and even recessions are not a reason to sell them. Over the past 50 years, by far the worst stock market contraction happened in the 2008 financial crisis. However, even that was short-lived. People that sold off their investments were either faced with being out of the markets altogether or having to get back in the markets when prices were appreciating. The lifetimes of other major bear markets were similar or even more short-lived. The first lesson in managing personal risk is to hold your investments through downturns. The second lesson is that rather than giving into fear, you should start to see market downturns as opportunities. When prices are rapidly dropping due to a market sell-off, you should be buying shares. It's impossible to know where the bottom of a market is, and you shouldn't concern yourself with that. At any time that share prices are declining, it's an opportunity, and so you should be making regular stock purchases. In 1 year, 2 years, or 5 years down the road, on average, the stocks that you purchased in a downturn are going to be worth quite a bit more. The second problem that arises as a part of personal risk is greed. Many people start seeing dollar signs when they begin investing. Having a get-rich-quick mentality is not compatible with successful investing. Your approach should be centered on slowly and steadily accumulating wealth and not making a quick buck. As you invest, you're going to be coming across claims that certain trades or stocks are the next best thing, but you're better off ignoring such claims. More often than not, they turn out to be false. The stock market is not a gambling casino, even though many people treat it that way. You can avoid succumbing to greed by maintaining a regular investment program and not being taken in by the temptation that you can profit from short-term swings or penny stocks that are going to supposedly take off. Finally, there is the related problem of impatience. After the Great Depression, people developed a more reasonable and cautious approach to the stock market. They realized that you're not going to get rich in 6 months or a year. The idea of long-term investing became dominant. Unfortunately, in recent years, this lesson seems to be getting lost. More people are behaving like traders rather than as investors. Far too many investors are being taken in by the seduction of being able to beat market returns. Instead of being impatient, you should realize that you're in it for the long haul. Rather than trying to make a few extra bucks now, you're seeking to build wealth. Risk of loss of capital. Obviously, financial risk is something you face when investing. Theoretically, there is a chance that you will lose all the money you invest in the stock market. This can happen if you tie your fate to a small number of companies. Several well-known companies like Lumber Liquidators, Bear Stearns, and GM have either had major problems or gone completely under. Investors may have lost large sums in the process. The way to deal with this is to avoid investing in a small number of companies. Later in the chapter, we will investigate diversification as an investment strategy. You'll also want to pay attention to the types of companies you invest in. Putting all of your money into small-cap stocks, for example, is probably a bad idea. So is putting all of your money into emerging markets or into one sector of the stock market. Again, the key message is diversification. It's the way to protect you from financial risk. Market and economic risk, some factors are beyond your control, and the economy inevitably cycles through slowdowns and downturns. The market will cycle along with the economy and also experience crashes when the economy may be doing fine overall. This happened in 1987, for example. While these factors are not under your control, how you react to them is under your control. As we discussed in the section on emotional risk, you should not panic when there is a downturn. Remain level-headed and use downturns as a buying opportunity. They are always followed by a brighter day. Your job is to have the patience to wait for it to arrive. Interest rate risk. Changing interest rates can impact the markets. Although this is a book about stock market investing, you should have some awareness of how bond markets work. You should also be aware that investor money can flow back and forth between bond and stock markets depending on conditions. One thing that bond markets offer is the safety of capital, especially when we are talking about U.S. government bonds. When interest rates are high, U.S. government bonds and other types of bonds, including corporate and municipal bonds, become very attractive. Interest rate changes have risks for bond investors, however. Bonds are traded on secondary markets. When interest rates rise, bond prices fall because older bonds that offer lower interest rates become less attractive. Conversely, when interest rates fall, older bonds that pay higher interest rates have more value than new bonds being issued that pay relatively low rates. This doesn't directly affect a stock market investor, but if demand for bonds rises, that can mean less capital flowing into the stock market. Less demand means lower prices, so the market may see declines. Also, as we'll see, you can invest in bonds through the stock market using exchange-traded funds. If you are using this method, you'll want to keep close tabs on interest rates. That means paying closer attention to the Federal Reserve and its quarterly announcements. You should be doing so even if you are not going to invest in bonds in any way. Announcements on interest rate changes can have a large impact on stock prices. But as always, keep your eye on the long ball. If the markets react negatively to an increase in interest rates, that can be an opportunity to buy undervalued stocks. Political risk and government and politics can create big risks in the stock market. International events can cause market crashes, and these days even a tweet from the president can cause markets to rise and fall. Lately, some politicians have also been discussing breaking up the big tech companies. Others are talking about investigating them. Such talk and worse actions can have a negative impact on the markets. Part of your job as an investor is to keep a close eye on the news. You're going to want to know what's happening so that you can adjust if necessary. Inflation risk. Inflation hasn't been high in decades. However, in the late 1970s, inflation rates were routinely in the double digits. Hopefully, that isn't going to be something that happens anytime soon, because high inflation rates can eat your returns alive. If the stock market is appreciating at 7% per year, but inflation is 14%, you can see that it's like having debt but investing in stocks. It's a losing proposition. Right now, inflation risk is very low, but you'll want to have some awareness of it and always keep tabs on it. High inflation rates also tend to go hand in hand with high interest rates, since the Federal Reserve will raise rates to try and slow down inflation. That means that bonds might become more attractive when inflation gets out of control. Taxes and commissions. Finally, we have the risk imposed by taxes. Of course, we are all going to be hit with taxes no matter where our money comes from. However, you need to take into account the taxes that you are going to pay when it comes to any gains you realize on the stock market. Part of being a successful investor is having an understanding of how much your taxes are cutting into your profits. If you are investing for the long term, it will be less of an issue. But keep in mind that taxes can really eat into short-term trades. Frequent short-term traders also face risk from commissions and fees. If you execute a lot of trades, the commissions can add up. This is not an issue for long-term investors. Risk versus return. One of the fundamental trade-offs that an investor will make is risk versus return. Generally speaking, the higher the risk, the greater the possibility of good returns. In 1998, Amazon was a pretty high-risk investment. While it had potential, major bookstores like Borders and Barnes and Noble dominated the space. Amazon was on shaky ground at the time, and another company could have come in and competed successfully for online book sales. That never happened, and Amazon ended up dominating book sales and expanding widely across retail and into cloud computing. That risk has translated into massive returns. A $10,000 investment in 1998 would be worth more than $1 million today, but hindsight is 20/20ths. Today, there are similar opportunities all around us, but it's hard to know which ones will end up being successful over the long term. If you are an aggressive investor, part of your job will be estimating which companies are the best baits for the future. These examples serve to illustrate why a diversified portfolio is essential. Managing risk. There are a few time-tested strategies that have been developed that help manage risk. They even minimize, as much as possible, the kinds of risk that you will face that are completely out of control. That could include anything from a terrorist attack to interest rate changes. These strategies are simple and easy to understand.